According to our next guest, history says this isn't a bottom, and the bear market will likely inflict more pain. Joining us now, Paul Hickey from Bespoke Investment Group. Oh, you party pooper, Paul. Why do you say this?
Well, Tyler, I wouldn't say I'm a party pooper here. All we're doing here is comparing the characteristics of typical bear market lows to the current period. And what we highlighted at the time a couple of weeks back was that the last legs of a bear market from all-time highs are typically very violent, and they inflict a lot of pain. So you tend to see a real sharp decline on the way down. In the last 6 months, you tend to decline over 20%. In this current period, to the October 12th low, we declined 14%. The 3-month decline was also much more mild than average. It was only the 1-month decline that was in line with the historical norm, so to speak. So just pointing out the fact that bear markets are typically violent. This one wasn't necessarily violent. The other thing about bear market bottoms, though, which is important to remember, is that the low is there's very usually a small window to get in. The median amount of time that a bear market low trades within 5% of the ultimate low is 10 trading days, and then on either side of that low. Whereas in the current period, we saw more than twice that amount of trading days so far. So there was an extended window for investors to get in. So all we're highlighting again is the fact that bear market lows are typically pretty violent. This one was painful, but not quite as violent in the past. Yeah. The other thing to remember, though, is on the other side, and this is what we advise in the report, is that kind of behavior shouldn't cause someone to sit all out and get all out of the market. You should never be all in or all out. And that's because on the way up, the rally typically is just as extreme as the leg down. So what we've seen historically is in the first month of a bear market, of a rally off a bear market low, the S&P rallied a median 15%. And over the next 6 months, it's about 30%. So investors just have to take a wait and see approach to the market and weigh the pros and the cons. And there are certainly, while the historical playbook doesn't necessarily hold suit, there are some positive signals within the market that we've been noting as well. And so you got to take the good with the bad and inch in here as you see fit.
Let me get a quick response to something I heard in the last hour, and that was one of our guests saying that the GDP number out today sort of indicated that maybe the economy is doing a little better than some people thought. Number two, that I believe she was starting to sort of sense, her spidey sense was that maybe we're in one of the later innings of the interest rate hike cycle, and that after November, perhaps the Fed will not pause, but maybe change its language a little bit, and that may be one of the reasons why the market is moving the way it is. Do you sense that at all? What would you say to that individual?
Well, so I think that's a great point. So the fact is that the market low happened, the intraday low happened the day of that CPI report, which basically killed all hopes as far as sentiment was concerned that inflation was abating. So the ball was there for the bears to take this market and take it much lower, and they went the wrong way with it, so to speak. Yeah. And we ended up rallying. So that kind of signal from the market tells you that perhaps while the market is looking forward, and investors are looking at the headlines and that they're not market positive, but the market is looking forward, and inflation numbers are going to start coming in here. We think just based on the comparisons in things. So I think in that respect, there, the prior guest, what they were referring to in the last hour would make some sense.